This is Voxcrest Report. I'm Daniel. United Kingdom lawmakers are warning that artificial intelligence in financial services could cause serious harm unless regulators move faster. The warning comes from the House of Commons Treasury Committee in a report published on January 20th, 2026, focused on artificial intelligence in financial services. The committee says key authorities, including the Financial Conduct Authority, the Bank of England, and Treasury, are taking a wait-and-see approach. And lawmakers argue that approach could expose consumers and the financial system to potentially serious harm. One reason this matters is scale. The report says financial services is ahead of most other United Kingdom sectors in adopting artificial intelligence. It cites that about 75% of United Kingdom financial services firms are already using artificial intelligence, especially insurers and international banks operating in the United Kingdom. But lawmakers say there is a gap. The United Kingdom does not currently have artificial intelligence-specific legislation or artificial intelligence-specific financial regulation. Instead, regulators rely on existing rules, and the committee says firms still lack clear practical guidance on how those rules apply to artificial intelligence systems. The report highlights several consumer risks. First, opacity. Artificial intelligence decisions in credit insurance and pricing can be hard to explain. That makes it difficult for people to understand why they were rejected, charged more, or offered different terms. Second, discrimination and exclusion. The committee warns artificial intelligence may worsen exclusion for disadvantaged or vulnerable consumers if models learn patterns that correlate with protected characteristics, or if automated systems push people out of certain products. Third, unregulated advice risk. Lawmakers warn that artificial intelligence tools like chatbots and search assistants can deliver incorrect financial guidance and mislead consumers in ways that do not always fall clearly under current advice rules. Fourth, fraud. The report says artificial intelligence can amplify fraud, making scams more convincing, faster, and cheaper to run at scale. Beyond consumers, the committee flags risks to financial stability. One major concern is cyber and operational resilience. Artificial intelligence can create new vulnerabilities and can increase the volume and sophistication of attacks on financial firms. Another concern is concentration risk. The report warns the United Kingdom financial system relies heavily on a small number of large United States technology providers for cloud and artificial intelligence services. Lawmakers say that dependency could become a single point of failure for the city if a major provider suffers an outage or disruption. And there is a market behavior risk. The committee warns that if many firms use similar artificial intelligence models, they could react in the same way during stress. That herding behavior could amplify volatility and, in a worst-case scenario, contribute to a crisis. Lawmakers also focus on accountability. They say firms and senior managers are uncertain about who is responsible when an artificial intelligence system causes harm. The report ties this to the senior managers and certification regime and says unclear expectations can both raise risk and discourage adoption because managers do not know what level of assurance is required. The committee criticizes regulators for emphasizing monitoring over rule clarity. It notes initiatives like an artificial intelligence consortium and controlled artificial intelligence testing programs. But stakeholders told the committee the approach is too reactive and leaves firms without firm guidance. The report then pushes for specific action. It urges the Financial Conduct Authority to publish comprehensive practical guidance by the end of 2026 on how consumer protection rules apply to artificial intelligence and what accountability and assurance senior managers must provide. It calls on the Bank of England and the Financial Conduct Authority to run artificial intelligence-specific stress tests that model artificial intelligence-driven market shock scenarios. And it pushes for faster designation of major artificial intelligence and cloud providers as critical third parties by the end of 2026, warning that the current rollout pace is too slow given the dependency risk. The core message from lawmakers is that artificial intelligence in finance is already widespread. The risks are real, and waiting for problems to appear before setting clear expectations could leave consumers and the wider system exposed. You're listening to Voxcrest Report. Subscribe for fast updates, and I'll see you in the next report.